Welcome to the channel. I'm James, and today I'm going through my valuation methods for UPS, United Parcel Service Inc. They had their earnings, and we are going to be going through them today and giving my updated fair value using discounted free cash flow models and the Buffett-Graham intrinsic value. So you can see right now the stock is $230 a share, up almost 14% on the day, broke through their previous highs. This is an all-time high, but is this still the right time to buy? So why is this? Well, UPS stock jumps after earnings easily beat amid supply chain woes and dividend hike of 49%. That's absolutely massive. So what is this saying? Well, estimates expected, and this is Wall Street, expected UPS earnings to rise 17% to $3.10 a share, with revenue up 9% to $27 billion. Well, their earnings rose 35%, blowing out estimates to $3.59, and revenue climbed 11% to $27.77 billion. In their outlook for 2022, UPS sees revenue of around about $102 billion, which views for just shy of $100 billion, and then obviously they've increased their dividend 49% to $1.52 a share. So very, very bullish, and the market has acted accordingly on that. As I said, we're going to be going through these full year consolidated results because UPS has been kindly enough to summarize it here. But before that, what we'll be doing is going through my usual steps. So market cap of UPS is $2 billion. Share price is $229.83. 52-week low of 154 and 52-week high, which was all-time high of 232. Dividend is 1.2% at the minute. Obviously, that is without the dividend increase. And the ex-dividend date is the 7th of Feb, so buy before then if you want it. P/E ratio less than the market. No, P/E ratio of UPS is 31.37, with the market is around about 24-25, so that is a fail, but apart from that, everything else is about to go green. Revenue, 71.8 billion to 97.3, and if we just go to the earnings there, you can see the revenue has increased 15% to 97.3 billion, so that is obviously a pass. Next, what we want to be looking at is if the profit's increasing. Profit has tripled in that time, 4.8 billion to 12.8. Once again, operating profit was 12.8. Adjusted operating profit was 13.1. So that's up 50% on the previous year. So massive, massive increases again. Are their shares outstanding increasing? No, they've actually gone up, but they did buy them back and they've issued more shares. So this is a fail, but it doesn't seem to be a worry. I think UPS consistently has been buying back their shares, but the latest shares outstanding numbers aren't out yet, so this might have even changed since then. So don't be too worried about this. It stayed relatively flat. In fact, what I'm going to do is I'm just going to give it a pass if I can do it. My Excel spreadsheets won't let me because I've coded them to not let me do that. But I don't think this is a massive problem. Next, what we're going to be doing is the free cash flow. Is that increasing? Yes, 6.4 billion to 10.9. So that is a massive, massive pass. Overall, that gives us 3 passes, but I say 4. And the free cash flow ratio is the market cap divided by the free cash flow, which is 10.9, which gives you a free cash flow ratio of 18.22, which is very, very low. Is that dividend safe? Yes, it is. 10.9 billion to 4.1. So that is also another pass. Now we're going to be looking at the discounted free cash flow ratio. So this is calculating the future free cash flow ratios, but I'm going to do something different today. I'm going to show you how this is calculated. We've got free cash flows of 2018, 2019, 2020, 21, 6.4, 2.2, 5, and 10. We've got the net income. Net income was pretty consistent in 18 and 19, 4.8 and 4.4. Lower in 2020 with 1.3, but net income is up massively in 2021. And the free cash flow, 6.4, 2.2, 5, and 10. So we've got the free cash flow to net income ratios here, and we're taking an average as it's currently standard, and that would be an average of 162%, which would then give us our future free cash flows. We've also got revenue growth here, 71, 74, 84, and 97. These are 2 analyst estimates that they're providing, 96 and 100 in the coming years. And once again, we've took an average, which gives us about 6.23. That's calculated the future revenues. And then we've got the net income margins here, 4.8, 4.4, 1.3, and 12. And we've averaged those out again, and this has calculated the future free cash flows based on that. So what does that give us as a fair value based on discounted free cash flow? Well, this would say the stock is massively undervalued at $367.23, which means it's at a pretty high discount at 59%. Say that we are not going to get the free cash flow of around about 10 billion this year. Let's just drop that down a little bit. We'll take these averages because I think these are a little bit more fairer. That's an average of about 90%. So that would give 5, 6, 6, and 9. That would have the stock about fairly valued at the minute, but that would be meaning that it would be going back to 2020 levels, which is going to be a bit out there because obviously that was the year of the pandemic. So I would say once again, raise that a little bit higher to get a fairer number. Still, stock undervalued right now. Next, we're looking at the Buffett-Graham intrinsic value models. And let me just quickly go back to where I was so we can get the original number. The Buffett-Graham intrinsic value takes earnings per share, expected growth rate, and the AAA bond yield into account. And this says that the stock actually has a value of $318.86, which is a 40% discount. So both of these models are saying it is a buy right now. Both of the models are in line. Obviously, the discounted free cash flow is varying a little bit more because of this high cash flow in 2021, but it is in line with the Buffett-Graham intrinsic value, saying that it is undervalued even at this massive price increase for the day. Now we're going to just look at some technical analysis because when I don't include this, people say they want it. And we've got the moving averages here, 50, 100, 200. 50 in green, 100-day in yellow, and red is the 200-day. So what are we seeing right now? Well, the price has broken way above those three major moving averages, which is a massive bullish signal. 50-day is about 207, 202, and 202. What does this stock tell us that it's been previously? Well, I like to look at the 200-day. You can see when the stock has broke below the 200-day, it's had a very bullish move to the upside. The last time it did this was in September, where it dropped below and shot up. And here again, that was about before earnings. It looks like this was ahead of earnings where the price dropped, where the movement was, whereas this time it dropped below it and increased. Nothing really else I would like to say on this. I mean, the stock does consistently break above the averages, but once it hits that 200-day, that looks like a buying signal. Even if we go back to 2020, well, this was pre-pandemic when the stock was $100, it did drop below 3 and then shot up. But this 200 as acted is a pretty consistent support for the last almost 2 years. Next, what we'd like to look at is the MACD. Let me just add that indicator. So what are we looking for here? Well, we want to see bullish price movement. Well, there you go. Here's the switch. So we want to see the signal line and MACD line crossing, which they are, which is a buy signal. You can see that this is displayed by the green histogram, but also these prices are about these lines are about to move above the zero line, which would be a bullish signal as well. So MACD is looking pretty bullish. Even if you were to buy now, this would still be a good signal because yes, it's on the green side, but these look like they are going above the zero line. If we go back over the last year, you can see when it's done this. The MACD line was below, even switched here green, but when it went to the positive, which was being about on October 18th, it went from $195 to $220. So MACD is very bullish as well. Then finally, we want to look at RSI, which is Relative Strength Index. And this is whether the stock is in overbought or oversold regions. So this is on the daily level. You can see the stock has shot dramatically into overbought regions, but just a couple of days before, it was in oversold regions. And we can see here consistently when it has been oversold regions, we've had a big move to the upside again. They're oversold. Here, not so much actually. It did drop below and raise up, but the RSI has been pretty good. But right now it's in overbought regions. And if we look, we'll zoom out a little bit. It has tended to have a bit of a sell-off after that. And finally, one thing I didn't do, which I normally do, is compare it to SPY. This is always a good thing to see how the stock has been doing. And we'll just go to the year. SPY is up 20% on the year, whereas this is currently up 48% on the year. And even on the year today, where obviously the SPY is down about 6%, this is up 8%. So this stock is comfortably beating SPY in the short term. If we go from the pandemic, pretty much neck and neck, but if we go to the 5-year chart, you can see that this stock has consistently beat the market. Not so much in 2019 and 20, but after the pandemic and with the new reliance on these kind of companies, it is looking like a pretty safe bet. And the whole goal is to beat the market. If you're beating the market in the short term and long term, then it's looking good. Right, guys, thanks for watching. Please give a like on the video, and I'll catch you guys next time.